Hi, everyone. My name is Kristen Harrison. I'm Director of Business Development for the Smith Group, and I co-chair the Programs Committee for Cornet, North Texas with Melanie Daughtery from Hayworth. Thank you so much, everyone, for being here. If you don't mind, please shut off your video. It's just helpful with our bandwidth. No problem if not. Also, I have everyone muted. If you don't mind, stay that way. Also, we encourage questions. Please enter them into the chat. We'll be monitoring those and ask Spencer those at the end. But we would love to hear from everyone. So this is our fourth, maybe fifth virtual event for Cornet, North Texas. We have one more in this series, and that's next week, next Wednesday. So look for an invite today. And that's going to be the end user panel. So we'll have 3 commercial real estate end users, and then Natalie from Cushman and Andrea from JLL will be moderating. So that'll be a really great event. So look for that. But I am so excited about this one today. So I'm going to introduce Bill Guthrie, who everyone knows. He's our 2020 chapter president. He took over on April the 1st. Right smack dab in the middle of a pandemic. So congratulations, Bill. He's going to say a few words and then introduce our speaker, who will talk a little bit to us. And then at the end, we'll open it up for questions. So once again, thank you so much for being here. And if you wouldn't mind turning your video off, that would be fantastic.
All right. Well, thank you, Kristen. And thank you to our programs committee who have done such a fantastic job during this trying time to convert our opportunities to gather to this platform that we're all getting to know so well, this virtual platform. So thank you, team, and super excited about our weekly opportunities, our chapter coffee chats. Please visit our website to see what other opportunities there are to gather and share thoughts. But as Kristen shares, I too am super excited about this morning. Spencer Levy, I got to hear in Anaheim at Cornet's national convention last fall. Very entertaining economist. And I don't know if that's an oxymoron or not, but it's the truth here. This guy is really fun to listen to. He's chairman of the Americas Research and senior economic advisor with CBRE, which is the largest real estate provider in the world. He's regularly on major business publications and frequently a guest on television. And I think he was on CNN this morning. I'm actually at work, which is kind of fun for me, a nice change this week. But he's on Bloomberg, CNBC, PBS, and Fox oftentimes. Been in the business for 23 years and in commercial real estate specifically, and 11 with CBRE. And he's redefined the role as a research leader. He combines his experience as a lawyer, investment banker, capital markets leader, and really goes deep into some really great subjects here. Super excited to be welcoming Spencer this morning. And, you know, Spencer, I'll let you take the virtual platform. And as Kristen shares, we'll pose some questions at the end. So welcome.
Great. Well, thank you, Bill. And for a guy who designed my office that you're seeing behind me after the movie The Godfather and slicks back his hair like this, you'll be surprised to know that I actually am a Texan. So, well, here's the story, Bill. I grew up in New York, but my in-laws live in Fort Worth. And so they took me when I was 24 years old to have barbecue for the first time in my life to a place called the Railhead on South Hewlin. And when I walked in there and they served me this brisket with the black rim around the side, looked nothing like the brisket I grew up with. It looked like pot roast. And they gave me a beer that I could have bathed my child in. And my grandfather-in-law goes, well, just try it. So I had one bite of Texas brisket, and it was like a vision from the Lord. It was the best thing I had ever eaten. So I'm not a real Texan, but I'm a Texan at heart, and half my family lives down there. So I'm delighted to be speaking to my friends in North Texas today. And so what I'm going to do for the next 20 minutes or so is I'm going to give you my point of view on what's going on out there. And after that, I'll take questions, and we can put it in the chat room, or Bill can moderate, or both. And so a lot of people ask me, well, what have you been doing for the last 2.5 months? Well, I've been on calls like this nonstop, and somebody asked me yesterday, how many people do you speak to? And I said, about 100,000. And then I added it up, and I was actually low. I've spoken to closer to 150,000 because I do calls like this all day, like long, all over the world. And I do it not just to share my point of view, I do it to learn yours because I'm searching for the same answer that everybody else is searching for. How long is this going to last? And what does it look like when it's over? And that's why it's so important that I spend my time talking to my colleagues in Asia, in Europe, on both the occupier and the investor side to say, well, what is the best time period to look at? And so to organize my comments today, I'm going to break it into three basic categories. One is macro, the big picture. Second is micro for commercial real estate. And then the third is secular. Well, what's the future of commercial real estate? And the CNN gig that Bill referenced a moment ago that I did this morning was all about the future of office. And if I were to describe what my life has been for the last week, it has been nothing but defending the future of office, which we believe is going to be just fine. But in the short term, we'll have its challenges. So let's begin with the big picture. So when you're looking at the big picture, everybody knows where we are and where we're going, right? We are in a terrible recession. Second quarter is going to be awful. And the question is, how quickly do we come out of it? Well, you should know that CBRE is in the optimistic camp, and that would be shaped like a V. And sometimes when I say V, I sometimes think back to my Sesame Street watching days because everybody's coming up with a different letter of the alphabet to describe what's going to happen. Is it a V? Is it a U? Is it an L? Is it a W? And the reason why we're in a V camp is because of the comps we're looking at, the comparable time periods, comparable transactions. Because look, let's face it, folks, I'm a real estate guy. And as a real estate guy, the only thing I really trust are comps. And so the comps that most people are looking at are the comps of the post-global financial crisis period and the comp of the post-9/11 period. And those are good comps because most of the people on this call lived through them. There's a lot of data about them. So you can say, well, this is what happened then, and maybe this will be like that. But the problem with those comps is they may give you a misleadingly pessimistic picture because they ain't perfect. And by the way, there ain't no such thing as a perfect comp, but you should expand your lens to look at what's happening in Asia today. What happened in Asia in 2003? Because if you look at those comps, you'll reach a different conclusion coming out of it quite a bit sooner. But let's go first to the two main comps that everybody's looking at, the GFC and 9/11. If you take a look at those comps and using the office sector as a proxy for the others, you'll see that office rents took about 2 years to go from peak to trough, another 4 years to bounce back. So 6 years, peak to peak. Values bounce back a bit quicker, about 4 years peak to peak. But then you've got to go through shades of gray. Well, there are market differences. So many of the markets that got hit really hard post 9/11 tech bubble were Austin, Texas, Boston, and San Francisco. Those same markets did quite well post GFC because the same thing that dragged them down then, the concentration in tech, really bolstered them then. And we think the same thing is going to happen today. That markets that have a high concentration of tech, healthcare, education are going to bounce back faster than those that do not. But then if you go into the industrial asset class, you go outside of office, you'll see that industrial never went down in value at all post 9/11 tech bubble. So you have to be shades of gray by market, by industry, by asset type. But let's go to Asia now for a moment and why it gives me some measure of optimism. I spoke to my colleagues in China yesterday, and they're telling me that office property tours for tenants that want new space, are at 85% of peak levels today. And now I spoke to them 3 weeks ago, and 3 weeks ago it was at 70%. And I spoke to them 2 months ago, and it was at 0. That's quite a comeback. And the comeback is also related to things like shopping centers. They're all open. Industry getting back to peak capacity. Starbucks all open. So there's a lot of positive news there. But it's not all positive because there's some things there that haven't come back. Intercity travel and certainly air travel hasn't come back. Large purchases of automobiles and single-family homes, those haven't come back. So it's not all wine and roses over there, but it is a much more optimistic picture than if it is being painted, perhaps what you're feeling in your guts here today in the United States. Now, why is it going so well, relatively speaking, over there? Well, Two reasons. One, they've been through this barbecue before. They've been through SARS. They've been through H1N1. So they were prepared. How prepared? I spoke to my colleagues in Asia yesterday. They're telling me that Taipei in Taiwan hasn't had a new case of COVID-19 in 30 days. And what has been the key? Not only the fact that they've been through this before, so they had experience, so they were prepared, but the systems that they've put in place are allowing them to open in a more targeted manner than what we're doing today. We're putting everybody in the same boat. And that comes down to what we call the 3 T's: testing, technology, and tracking. And since they have these 3 things, they can segregate those people who are infected and protect those who are most vulnerable. And we think some measure of this is coming here to the United States. Now, I will tell you that it's going to be done on a case-by-case basis. Some companies are requiring their employees to self-test at home. And the CBRE just did a survey of our largest corporate clients, some of whom are on this call here today. And 45% of our corporate clients are going to require their own employees to take temperature checks before they come into the office, or and if they have an elevated temperature, not to come in at all. But ultimately, we are going to see some measure of this TTT approach. And as Bill suggested in our pre-call here, he's in his office right now, but they're going to do it in shifts to be able to segregate or to minimize the number of people. Now, these shifts are going to be different by market. Now, in most comebacks of the economy, you typically see the big cities coming back first: the New Yorks, the San Franciscos, downtown Dallas, tall buildings, right? Well, this time might be a little different because those buildings that have either A, dependency on mass transit, and B, have elevator capacity issues may come back slower than those that are drive-to, lower, shorter buildings, so that people can walk up and down stairs and do other things to get more capacity in them sooner. But all that being said, we still think offices are going to come back in about 18 months, similar to they were before, but there'll be increased wellness, better HVAC, other things, maybe even less density that will make them a safer, quote, weller, if that's even a word, environment. But let's go now to the micro. Let's go to our outlook for commercial real estate and the 5 major asset types. Now, for those folks on this call who have seen me speak before, including my event in Anaheim, which, by the way, as a complete non sequitur, I tell people that I opened up for Spike Lee because Spike Lee spoke right after me. I didn't really open up for him, but it sounds cool. But in any event, I am going to talk to you in a minute about the next 1, 3, 5 years. But for the next 2 minutes, I'm going to talk to you about the next 90 days. Because the next 90 days are the most important 90 days in the history of commercial real estate, because we don't know what our assets are worth. We don't know what rents are because we lack what's known as price discovery. Price discovery requires comps, and there aren't a lot of comps out there right now. But when will we have comps? Well, when the market bottoms. Now, here's the good news about when we think the market's going to bottom. So we track collections. CBRE manages about 8,000 assets in the United States, about 1 billion square feet. And based upon our collections data from April and including into May, we're above our expectations in multifamily and in office. We are also above our expectations in industrial, but we are below our expectations in retail. Retail about 50%, office and multifamily at above 90%, industrial around 85%. But here's an interesting little story about industrial, because industrial was tracking at 77% until about 3 days before the end of April. What happened? People paid their rents late. Why? Well, let me give you a quick case study. My wife owns a physical therapy practice right here in Baltimore, Maryland. And she had her business shut down and she did not pay her April rent until the last day of the month when she got a government check. She got a PPP loan, was able to pay her employees, was able to pay her rent. What's my point here? My point here is that the government programs have been imperfect, but they've actually raised the bottom. The bottom of collection is going to be higher than we expected in office, industrial, and in multifamily. And multifamily being bolstered, of course, not just by PPP loans, but more importantly by unemployment insurance. So the bottom won't be as low as we thought. But when are we going to get to bottom? If you speak to our colleagues, we think we're going to get to bottom in June. And getting to bottom is bad, but it's better to get there sooner rather than later, so we can start to come up, so we can start to know what rent roll we're buying if you're an investor, so we could know what market rents are if you're an occupier, which is most of the folks on this call here today. And so we think we'll get there in June, and we think the June over July comp of seeing not only transaction volume, but collections will be very, very important. Now, what are people trying to do to bridge this period of time here when they don't have price discovery? They don't know what values are. They don't know what rents are. Well, they're doing a couple of things. First, on the capital market side, they're putting together rent escrows of 6 months to 2 years rent to be able to bleed it down over some period of time while rents are being collected, because we don't know what they're going to look like over the next 18 months. But from an occupier perspective, we're seeing two things. One, we are seeing more occupiers doing short-term extensions, not long-term strategic extensions, to strategically kick the can down the road, so to speak, until there's more clarity. But those occupiers that have gone long on our leases, many of them are entering market rent reset provisions in there, so that if they do go long, they can have the ability to mark their rents down to market a couple of years out. So there are people doing these stopgap measures to try to get through this a very challenging period. But let's look forward now. Let's talk about our forecast for the major asset classes. And we have put our forecast into what we call our 1, 2, 3 buckets. And 1, those asset classes that are going to come back in year 1, 2 that will come back in year 2, and 3 in year 3. So in the year 1 bucket, we have multifamily and industrial. Now, we came out with a report about multifamily about 3 weeks ago, and that report showed that multifamily rents, apartment rents, are likely to fall about 8% this year, but start to come back in the first quarter. Vacancies are likely to increase by about 6%, but also come back in the first quarter of 2021. Now, there's shades of gray all over by market, but also by sub-asset type. And there are some sub-asset types within multifamily, notably senior housing and student housing, that's going to take longer to come back. Now, some of that is dependent upon what market you're in. So California recently announced that half of their state universities will not open in the fall. But I saw in Texas, they did not make that announcement. It's the opposite. So student housing is likely to perform much better in the state of Texas than it is in the state of California, certainly over the short term. Senior housing is a more complicated story, but ultimately, because of the mega trends of an aging demographic, the need for this, even though the next 12 to 18 months are going to be challenging, it's going to be just fine beyond that. Now, industrial also, there are shades of gray, because while we believe industrial is going to come back at a similar pace to multifamily, it's not all industrial. It's going to be big box warehouse distribution first, secondary flex or small bay, because many of the tenants in the small bay industrial are folks like jump houses. And anybody on this call that has a kid or a grandkid has been to one of these jump houses. Where do you think they are? They're in flex industrial. And guess what? You ain't going back to one of those anytime soon. So the bottom line is they're going to be stressed from a rent, the ability to pay rent perspective, and there will be negotiations between landlords and tenants to try to figure that out over the short term, maybe some percentage rent. And then obviously that's going to require some conversation with your lenders. Let me make a side note here on capital markets for just a moment, because I think it's relevant to this conversation. So for every occupier on this call that has distress because of the COVID crisis, it causes distress to go up the chain if you have to ask your landlord for less rent. And then it goes up the chain even further to the lenders saying, I need to have some type of forbearance on my mortgage. Well, I think the good news is this, and this is actually real good news, where we have seen more accommodations from more lenders in this go around than in any crisis, maybe in history. Why? Because there are no villains here. In the prior crisis, GFC, you can blame Wall Street. In the tech bubble, you can blame the big tech companies. There are no villains here. And that's why you're seeing government agencies, not only in the United States, but also in Europe, giving accommodations. I'll give you one example of that. I was on the phone last week with a large German lender, and they have an $8 billion loan book here in the United States, $5 billion of which is in hotels and malls. So you can imagine they've been pretty busy over the last few weeks. What did they do? What they did was they gave covenant relief, meaning the borrowers did not have to hit their financial targets until the end of 2021, almost 2 years of covenant relief. And they did that with the blessing of the European Central Bank, who's their regulator. You're seeing similar accommodations being given by banks here in the United States. You're seeing similar accommodations by some insurance companies. So the good news is we are trying to kick the can down the road probably to the beginning of 2022, and there's been a lot of accommodation there. Now, in the two camp, those assets that are going to come back in year two is office. And as I said from the outset of this, if you want to know what I really do for a living for the last week, I have been fighting the fight about the future of office, including but not limited to this morning on CNN. What's the fight about? Well, because of reduced physical occupancy during the next 12 to 18 months until there's some type of resolution to the crisis, you're going to see reduced physical occupancy in the space. And a lot of people are saying, well, we never need to go back to the office. And you saw Jack Dorsey, the CEO of Twitter, say that publicly. We saw the chairman or the CEO of Morgan Stanley say something similar. And so, oh, we don't need this. This is a cost item. And when this is over, people aren't going to need to go back to the office. Well, I think that might be premature. And the reason why I think it's premature is two reasons. Number one, we all know that cost consciousness today is the number one consideration of all companies, as all of our cash flow is stressed in a variety of ways by this crisis, and people are looking to cut costs. Good for you, and that's what they should be doing. But that is a short-term phenomenon until the economy begins to recover. Once it begins to recover, they're going to begin to look at offices not dissimilar to how they looked at them before the crisis. And how they look at them before the crisis? They didn't just look at them as cost centers. They looked at them as places where people were more productive, they were happier, they were able to attract and retain talent, and it was able to create the culture of the company that you want. And a lot of this is generational. And it's not really age that matters, it's life stage. So millennials who previously all wanted to be in central business districts and in tall office buildings, once they got married and had kids, more of them wanted flex work, working out in the suburbs a little bit more. But now there's the Gen Z generation. Let me tell you something. You're a 25-year-old who just got out of school. Where do you want to work? You want to work in your parents' basement, or do you want to work in an office? I guarantee you 99% of them are going to want to work in an office. And that's not just them. It's a lot of people, myself included, that have what's known as pent-up demand to go back into the office, not just for the factors I talked about, productivity and happiness and attracting and retaining talent. It is collaboration, and that is a good thing. We are better when we are in an office, even though there are some tasks that can be done remotely. Now, when we talk about doing stuff remotely, what we're really talking about is what CBRE calls the, quote, fluid marketplace. And CBRE wrote a report called the 2030 report, The Age of Responsive Real Estate. We had a whole section on the fluid marketplace, and we saw that increasing. Now, increasing meaning some people working from home, working from a Starbucks, working from the office, or working from the back of a self-driving car when that comes around. That's increasing. But people are going to still go back to the offices for the reasons I mentioned before, but the office is going to change a little bit. Obviously, in the short term, you're going to have more overt wellness things. When I say overt, things like janitorial services, which used to be a back of the house function, is now going to be very much a front of the house function, not just so they can clean more, but they can clean and you could see it, it's a confidence builder. But longer term, you're going to see more wellness in the things like better HVAC system, cleaner air that's going to be zapped by ultraviolet light, or a system that one of our clients, a company called McCarthy Cook, is building in their buildings, where they're building in West Hollywood. They're building a $500 million office building now, and they're putting in what they call hydronic HVAC, which is hot and cold water being piped into your walls, into your floors, rather than pumping forced air in. It's more expensive, but it's cleaner, and that's the kind of thing you're going to see post-crisis. You're also going to see less density. You're going to see maybe less people, but more square footage for those people. So does that mean demand for less office space? It's not clear to me. So now in the 3 category, we have retail and hotels. And now, again, shades of gray, different types of retail are going to be hit harder, just like different types of hotels. And I think there's been an acceleration of some of these trends in areas that were well-known, second-tier malls, big box retailers. And unfortunately, one of them was based in the Dallas area, JCPenney, filed for bankruptcy on Friday. It was a terrible thing, but I don't think it surprised anybody. But really, it accelerated a trend that we had seen for some of these secondary market, big box malls. But we have hope in those areas too, where redevelopment is going very well, even in smaller markets, to change some of these malls into a live, work, play environment by adding office or by adding multifamily. But here's a really good news story about retail and specifically restaurants. which have really taken it on the chin. So I'll give you two quick stories on that. One of my close friends and colleagues, Chris Ludeman, lives in Dallas, and he on Sunday night tried to go out to dinner. He could not get into a steak restaurant in Dallas on Sunday night. Why? Sold out. I'll give you a second story. A client of mine, Alex Smith, is a restaurateur, owns about 12 restaurants, including one in Houston that he reopened about 3 weeks ago at 25% capacity. And I asked him on my podcast last week, how's it going from a revenue perspective? He's at 50% of revenues, 25% occupancy, 50% of revenues. And I said, well, how are you doing from a tipping standpoint? More than double as well. What does that tell you? Pent up demand. And people are also having a kumbaya spirit, tipping servers much higher than they normally would because, frankly, we're all in this together. And I thought that was a very positive sign, not just for restaurants, but a nice shout out to Texas overall. Now, hotels are going to be also in these categories of which is going to come back sooner or not. And the ones that are going to take the longest are going to be those that cater to international travelers or really any type of domestic air travel. Here's my one little negative I'm going to say about Dallas. I say this with love, but I'm just going to give it to you straight. I was on the phone call last week with the heads of lending from Fannie Mae and Freddie Mac. And these are the big lenders to the multifamily space. And they downgraded a few markets that you would expect. And these markets were Las Vegas, Orlando, New Orleans, the big tourist markets. But they didn't downgrade Dallas or Atlanta, but they talked about them a little negatively because of the size and the importance of your international airport. So there will be some segments of your economy, while your economy overall is expected to be resilient, and I give you studies on that, some segments related to travel, air travel in particular, are going to be hard hit for the next 12 to 18 months. But there are some elements of your market that are going to do very well over the next 12 to 18 months, even in the hotel space, where drive-to or quote-unquote staycation hotels are expected to spike in demand. I already know of a hotel on the coast of Texas near Houston that had 100% occupancy last weekend because people want to get out and do stuff. My son plays travel baseball, and he just got his tournament rescheduled for the first week of June in South Carolina, about an 8-hour drive from here. You know what I'm doing on that 8-hour drive to South Carolina? Number one, I'm stopping at the Greenbrier and playing golf. And number two, on the way back, I'm stopping at Pinehurst to play golf at nice hotels. Why? Because I'm sick and tired of sitting in my house. And I think a lot of people feel the same way. You'll see pent up demand there. But the business travel hotel and the international travel hotel will take longer to come back. So let me sum up my comments like this, and I'll take whatever questions you might have. CBRE is in the optimistic camp, and we are there because of the comps that we are looking at, the positive facts on the ground in China, and because we see this massive amount of federal stimulus that has not only raised the bottom, meaning the collections are better than we expected, but also because they've helped the banks so much to give relief for the most distressed borrowers that we think that they will be able to survive over the next 2 years, notwithstanding the fact their fundamentals are going to be constrained. So very bullish from the overall perspective. When I say very bullish, though, I want to put one note of caution there. Even in our bullish case, we believe that GDP is going to fall by 5% in 2020 and rise by 6% in 2021. That means 2 lost years. So even in our optimistic case, 2 lost years, and real estate will be a little bit of a laggard from that as well. But overall, I think we've painted a more optimistic picture than you're reading perhaps in the press or you may feel in your gut. So with that, Bill, I'll take whatever questions you got.
Awesome. Thank you, Spencer. Very insightful and entertaining too. And it is nice to hear some optimism. And it's interesting that you set forth CBRE kind of as an entity, as an optimist, but it's based on facts. So that's very cool. Hey, we do have a question here from Kyle Cooper. First, thanks. And do you think tenant office space size will decrease because of a push to allow employees to work fully, partially, remotely? Or could it possibly increase due to the need of social distancing? You obviously touched on it some, but again, what do you think, or what do your experts and cohorts believe?
Well, the way I frame it is very simple. For the last 10 years, prior to COVID, I said this months ago, going to the office is a want, not a need. Just like going to a restaurant is a want, not a need, but you still go. Why? You go because it makes you more productive, happier, attract and retain talent, and it creates a culture for your company. Now, have we accelerated the fluid marketplace where more people will work from home in the future than less? Yeah, we have accelerated it, but not to the point of diminishing office demand because of these factors I just talked about, the 5 factors of why going to the office is so productive, but also because it's less densification. Now, there is going to be a premium placed on new buildings, and I have a lot of funny expressions. One of my expressions I've used for years now is new is the new new. Well, new is the new new is going to be even more important in the future, particularly with respect to wellness, as people who have modern systems in there that make people confident about the safety of their building is going to prevail even more. And by the way, let's just call it what it is, folks. And I said this on CNN this morning. I said, there's a fear factor out there, not dissimilar to the fear factor that pervaded the market post 9/11. And post 9/11, what we saw was there were many people who didn't want to go back to the big cities. There were many people who didn't want to go up into tall buildings anymore. But that changed when security got better in these buildings. And we're going to see the same thing here from a wellness standpoint. As buildings become more wellness conscious, people are going to be very confident to go back in. And for these other factors, people are going to want to go back in. And because of less densification, I'm not convinced it means less office space in the future.
Okay. Hey, what are your thoughts on onshoring from China back to Mexico and, North America, South America?
Sure. So this trend of reshoring didn't begin with COVID-19. There was a terrific book that came out 3 years ago by Ian Bremmer called Haves versus Have-Nots, The Decline of Globalism. And what that book talked about was how reshoring was going to increase, not because of a pandemic, but because of cheaper automation, because of some more protectionism. And so globalism, in terms of the trade of goods, has slowed in the last 5 years, even prior to this crisis. And now that may accelerate, as the key word that will come out of this crisis is resiliency. If anything failed us in this crisis from a business standpoint, it was that we became too efficient. We became too much just in time. And now I think people are going to have to put some wiggle room into their supply chains. They're going to have some wiggle room in the amount of inventory they hold. And now some of that means bringing manufacturing back to the United States of certain things like pharmaceuticals. We saw an announcement about that yesterday, where a big pharmaceutical company is going to be formed in Virginia to have new drugs manufactured here rather than overseas. So we are going to see more of that here. But I like the way you frame the question, Bill, because I actually see more of it going to Mexico. I think Mexico will be the next the biggest beneficiary of it because A, they're right next to the United States. You can truck it here. But B, the cost of labor advantage in Mexico is so significant. The average Mexican laborer makes 10% of what an American laborer makes, that I think it makes sense to put a lot of it down there, though some of the higher tech, higher value add manufacturing will come back to the United States.
It'd be great to see some stability and vitality to come to Mexico. I've heard you reference the United States of California versus the United States of Texas. How do you think we're doing? And I see this as just a continuation, maybe, of things coming to North and South Texas.
Sure. So a couple things. So what Bill's referencing, and I didn't come up with this, I'm not that clever, to say that there's a real split of two Americas. It's not red and blue per se. It's the United States of California versus the United States of Texas, as our states just go about their business differently. So perhaps Bill saw this when I spoke in Anaheim in October. I talk about my 5 factors of awesome cities and states. And my 5 factors of awesome are the same everywhere I go. And they include talent, live, work, play, foreign money, infrastructure. But the last one, the 5th one, which is increasingly important, is ease of doing business. I speak not just to great occupiers like we have on this call here today for CoreNet. I speak to big investors every day. And they're asking me, where should I put my money? And they're all thinking about putting it in the southeastern United States and Texas because of ease of doing business. And so I think the divide from California to Texas and the southeastern United States is going to continue. And I say it regrettably to some degree, putting aside, I certainly respect people's places decision to have a easier or harder place to do business for a variety of reasons. Not to be political here, I think the political divide here is a national tragedy overall. And I think it shows up in this COVID crisis. I think ultimately, I wish that 100% of the decisions were based upon what is in the best interest of the people. I don't think anybody believes that. I think that a lot of the decisions are being made pro or con, open or close, based upon political considerations, and that's unfortunate.
Okay. This may be a tough one, but the question posed is trying to better understand negotiating market rent markdowns post lease signing. So I guess you felt that we might have a softening of the office market over the next couple of years. What's your team internally think about that, or landlords or your tenant reps?
Well, look, once your lease is signed, it's obviously very difficult to renegotiate with your landlord. But if you have a lease that's up for renewal, that's where you have the ability to make most of those changes. But there are circumstances where if you have a particularly stressed business, we've seen landlords negotiate with tenants to defer some rent to next year when they were better able to pay. And for the really distressed tenants, we've seen percentage rent regimes be put into place in the short term until they can have full revenues again. So lots of things have happened for people that have fully signed leases in this very unusual period of time. But it really comes down to a case-by-case analysis of the P&L of the individual tenant. That's what we've advised our landlords and tenants. Basically, we're very simple. If you're a landlord and you could pay your mortgage, pay your mortgage. If you're a tenant and you could pay your rent, pay your rent. But if you are distressed, you should have a conversation with your landlord and a conversation with your lender, because accommodations will be made based upon the distress of the individual tenant.
Okay. I had a banker friend point out that last time, I guess the global financial crisis, it took the federal government a year to get their act together and do something. And he said this time in 6 weeks, they acted appropriately, and he was blown away. But what does scare me, and in the big picture, is what does this mean to the national economy in terms of supporting, and shallowing the what did you call it, the bottom there? It's good right now, but it's kind of scary in the long run. As an economist, what do you think?
Well, I have a very, and I believe I said this, Bill, in Anaheim. I've been on record for a long, long time saying that not only do I believe inflation is going to be lower for longer, I think inflation is going to be lower forever. And I believe that because there are mega trends out there led by challenging demographics, aging population, not enough birth rate, not enough immigration, too much cheap labor, too much cheap energy, too much cheap money, and then innovation itself squashes inflation. And you combine that squashing of inflation with this massively deflationary shock we have in COVID-19, and then you counter that with what you just suggested, Bill, of all this additional national debt, higher deficits. Are these higher deficits and debts going to unleash the beast of inflation again, 1970s style? Well, Milton Friedman right now is rolling over in his grave, is saying, yes, it is, because it's all about money supply. But I'm not so sure, because we saw a huge increase in the money supply post GFC, and we didn't see inflation then for the reasons I just laid out. And I believe the same thing today. Now, if I had my druthers, would I like to have a lower national debt, having a lower deficit? Of course I would, over the long term. Over the short term, however, I am unambiguously in the pour as much money as it takes into the economy now camp, because deflation is a much bigger long-term risk than inflation. And if we do not have the economy bounce back sooner, you're going to see far more long-term economic damage, even though having a high national debt, a high deficit is damaging in the long term if interest rates rise. And what I'm suggesting is I'm not that worried about interest rates rising, so I'm not as worried about it. And, I will tell you this. If you guys want to know where my prediction is on interest rates, the 10-year Treasury, I didn't look this morning, was around 0.7% last couple of days ago. Probably will get to 1% before the end of this year, 2020. And I think it'll get to 2% by the end of next year. And by the way, we should all hope it should. Why? Because it means the economy is growing. Next question, Bill.
Yeah. Question posed, how are you seeing the credit markets today versus 09 or 01? Are lenders still in the market? And then I'll add to that, or do you expect them soon to be back at it?
Well, when you speak to our debt and structured finance professionals, and I have a big call with them in about half an hour, they will tell you that the market bottomed on March 23rd. On March 23rd, that's when the credit market seized up quite a bit. Spreads blew out, meaning the cost of debt blew out. Most lenders were out of the market with the exception of Fannie and Freddie. Now, more lenders are back in the market. Spreads have compressed because TALF, the troubled asset program from the Fed, has worked. And number one. Number two, the guidance that has been given by regulators has worked and given borrowers relief. So the market is liquid, but it is constrained today. So if you want to get a loan in retail or hotels or a construction loan, very, very difficult, maybe impossible in certain types of retail or hotels, and only for the best borrowers in construction. But an interesting negative thing happened in the last couple of weeks. While it's been well known that retail and hotels have been constrained for some time, the lending environment for office buildings has gotten a lot tougher too. Because remember what I talked about a moment ago, that what I've been spending my time on over the last week is defending the future of office. Well, I'm defending it against some of the lenders who think that there's a problem. And so because of that, there's this period of time here where offices are much harder to finance. And that's why we've seen a material increase in many of our largest occupiers, including some of the folks on this call here today, consider alternative financing mechanisms, including sale leasebacks and ground leases.
Construction pricing and your project management folks, what do you see or they see in the next 12 or 24 months?
Well, two things. Number one, I hosted a call on construction last week. And if anybody wants a tape of that call, Bill, just shoot me a note. I'll get the tape of the call so they can hear the whole thing.
Do that.
The second thing is, this is what's happening. So the construction markets, there's two or three elements to that in terms of what's happening on job sites today. Are they open? Are they closed? And the safety, that's one element. This is just the cost of construction. This is what we're hearing. So and again, this is not a political comment. This is just called fact. In non-union markets, we are beginning to hear about contractors and subcontractors bidding against themselves, and that may cause a decrease in labor in some markets for certain subs of 10 to 15%. Now, that decrease will be most pronounced in subs that are specialists in things like hotels, of course, but you are beginning to see labor prices drop in these non-union markets. You're not seeing it in union markets. And in fact, during the global financial crisis, you never saw a drop really in union pricing at all. But the second question is, what happens to the price of materials? And we are seeing some material prices drop too. The price of lumber dropped by 25%, as an example. Asphalt, which is an oil derivative, we've seen some drop in that as well. So some material price drops, but most materials have not. In fact, some materials have gotten more expensive, particularly if people are doing the finishes on buildings. The finishes on buildings typically require finished products, which were often shipped from China or other places in Asia. And some of those supply chains have gotten constrained, so they had to resupply here from the United States. So some supplies have gotten more expensive, while some of the base materials a little bit less. So overall, a drop in construction prices in the short term is expected. And I say short term, once the economy ticks up again and subs and contractors have more confidence in their pipeline of work, we'll probably get back to about where it was.
Okay. Hey, one more question, and I'm wondering if you've seen it internationally. Do you think thermal monitoring integration with office security and CCTV systems are in our future here in the U.S.?
No, I don't. What I do see is what we polled our largest occupier clients last week. I actually have the survey right here on my screen, and 45% of our large occupier clients are requiring their own employees to self-screen when they're at home, and they're banning visitors at the moment. So the real question is, what do you do with visitors once that reopens? That's a different story. I would not be surprised if people have their visitors self-screen too in a certain way, and an ad hoc visitor will not be allowed in your building in the short term. So long story short is, I do see it, but I think I see it as a self-screening thing, not as a screening at the door. And that's partially due to the privacy and HIPAA issues that are associated with doing a temperature check. So I think most of our companies are saying do it at home, and they're coming up with systems for that.
All right. Hey, Spencer, thank you for your time. And out of respect of everybody's time, we're right at 45 minutes. This has been fun and encouraging, and we appreciate you. I am going to reach out and ask you to send that construction report. We'll send that to everybody who's online with us. And so thank you. Have a great day. Kristen, you got anything else?
I was just going to say, I'm going to send the recording out to everyone that registered. One last question. What is the grade that you would give Texas for the shutdown and the reopening?
Well, not to be political about this, but I was very encouraged by the restaurant story I was told by my restaurateur, by my buddy in Dallas. And I'm very encouraged that Bill is talking to me from his office today. I think people who experiment with opening should be applauded. At the same time, I certainly don't want to disrespect those that have a real fear factor about going in. So I think Texas for experimenting, certainly gets my praise.
All right.
Thank you, everyone. Thank you, Bill. Thank you, everyone, for coming on. And we will see you next Wednesday. So
thanks, everybody.
great presentation.